What most people don't know is that Nasdaq is a technology company by its core. Today we provide technology to more than 250 clients in more than 50 countries across all types of markets in the world.
The partnership between SGX and Nasdaq is more than a decade now. We are a multi-asset exchange. Our business is vertically integrated and we have an international presence. Technology is no longer separate from business. It's really about how we are reshaping business.
Tabcorp's vision is to be the trusted gambling entertainment company. Our wagering business, Tab, is Australia's largest multi-brand wagering company across digital channels and retail. Nasdaq's merge pool technology allows us to bring new products and opportunities to our customers.
Ladies and gentlemen, dear guests, welcome back to our annual ASEAC conference. We will start our morning session with a panel on the rise of an asset class and its impact on the African economy. Wishing you all a fruitful and productive morning. The floor is yours, Mr. Robertson.
Thank you very much, and welcome everyone to the second day of the Asia conference. This is going to be a panel that I'm going to go straight to introducing people. I want to get straight to work, looking at making African equities cool, and how it's happened, what's happening next. I've got three really useful panelists. I'll introduce myself first, and then allow them to introduce themselves. I'm Charlie Robertson, Chief Economist of Renaissance Capital. We're an investment bank that does a whole load of work across emerging and frontier markets. We've done business in Morocco, Egypt, Kenya, Lagos, everywhere we've got offices, plus South Africa and so on. And our job is to try and get people to recognize the opportunity on the continent and occasionally the risks. If I can also introduce our panelists, we have Sunil from Mauritius. Sunil, would you like to give the formal introduction to yourself?
Thank you. Thank you very much, Charlie. Good morning, everybody. I'm Sunil Benimadu, and I'm the Chief Executive of the Stock Exchange of Mauritius since 1998, so it's been quite a long time, and I've been very much involved in the African exchange space for the last 20 years. I've served as president of the ASIA, the African Securities Exchanges Association, for 6 years. I'm also very much involved within COSE, which is the Committee of SADC Stock Exchanges in the southern region of Africa. And I've also been involved within the exchange space at the global level as a member of the board of the World Federation of Exchanges. I'm very happy to be on this panel. Thank you very much.
Perfect. And Simon, if you'd like to introduce yourself.
Thank you, Charlie. And thank you to Casablanca Bourse for the invitation to take part today. I'm head of strategy at EFG Hermes. We are a frontier and emerging markets focused investment bank, the headquarters in Cairo. I was based in Cairo for many years, and we began looking at MENA equities, so Egypt, North Africa, and also the GCC. We've spread our wings a little bit in recent years. We now have offices in Nigeria, in Kenya, in Pakistan. We also look at Bangladesh and Vietnam. I'm on the sell side. So I also, like Charlie, help investors to understand the risks and opportunities in our markets. And in recent years, it's been very interesting for me to take a broader look outside the Middle East and look at some of the bigger drivers for our markets.
So we've got a panel where we've got the exchanges, we've got kind of that side, we've got the sell side well represented. And Isam, would you like to introduce yourself?
Yeah, thank you, Charlie, for the presentation, and I'm very happy to participate to this panel. So Wissam Babouchi, I'm the founder and chairman of Africa Asset Management. So my job is to invest in listed equities in Africa. Let's say that we are invested in around 10 countries today in Africa, and we are, very focused on consumers, telcos, banking companies as well. So I'm I have let's say the point of view of the investor and the point of view of the buy side analysts and fund managers. So I'd be very happy to share my point of view of the African stock markets and the listed equities that I'm interested in.
Brilliant. Thank you very much. So you've got the full spectrum here on this panel. So hopefully we can get down to lots of juicy stuff. I'm going to give a 2-minute introduction, and then we're going to do roughly 40 minutes of chat. And then there's going to be 15 minutes to answer your questions. So feel free to put the questions down along the right-hand side of this StreamYard thing. And right, leading off. Anyone who's had the misfortune of hearing me talk more than once will know that I'm a bit obsessed by education. And I think that what we've seen across the continent of Africa has been an incredible improvement over the last 50 or 60 years, where a legacy of colonial regime that left most countries with inadequate education. Countries had to deal with that themselves. They had to find the teachers who could teach the kids, who could then teach the next generation and improve literacy. And it's happened. The country that was furthest ahead of the ones I look at most of the time back in 1950 was Mauritius. And it's the second richest country per capita in Africa in recent years, just behind Seychelles, which was the only country with a better education number in 1950 than Mauritius. So Mauritius has kind of led the way, and we're going to come to that first. But what I've then found interesting is it's all very well having the education story sorted. What you also need is the infrastructure and to support industrialization. And to get that industrialization, to get that infrastructure, you need money. You need savings. And the problem for much of Africa today is still a lack of savings. Now, I relate this to things like fertility rates, which are quite high, and that's related to child mortality and a whole other set of longer issues that take time for countries to be able to address. Some have done so. North Africa's basically done it. The fertility rates are looking good. The savings rate in a country like Morocco is extremely high. But I'm very interested by a country like Mauritius, which had to go through the full process of too high fertility back 60 years ago, an education level that wasn't quite yet there for industrialization back in the 1950s, and what changed and how it changed, because I think there's some very interesting parallels between what's happened there and what's happening across the rest of the continent. The second or third problem, issue related to this, is that when you're short of savings, how do you address that problem? And the most obvious way is to go and borrow the money. And a whole load of countries have been doing just that. Debt levels have grown a great deal. External debt levels have grown a great deal over the last 10 years. Since the HIPC arrangements reduced the debt levels so dramatically for much of Africa in the late 2000s, the numbers are back up again. And there is a limit to how much countries can use debt to finance growth, particularly when it's foreign debt. And when you reach that limit, and Zambia went over that limit, which is why they defaulted last year. Ethiopia's gone over that limit, which is why they're looking for debt restructuring this year. Chad's gone over that limit. And others may well follow. So there is a limit to how much debt you can borrow, even in a global environment where US treasuries are still sitting below 2%, and the cost of external borrowing is not that bad. There is a limit. And if there is a limit, then how do you get that capital in? And I think equities then become essential, because the advantage of countries using equity investment is that they don't carry the burden if things go wrong. If you borrow too much external debt and you run into default, the country is stuck with that debt for years. Even a default won't write it all off. But if you attract the money in via equity investors and the company goes wrong, you know, these things happen. The company, it's the country is not burdened with a problem in the future. It's the equity investor who's taken the risk and has the upside, and a lot of upside, when it goes well. And we'll get to those with Isim a bit later. But it seems to be a much safer way for countries to be trying to address the finance challenge of the 2020s, given that there are limits on the debt. Now, I want to start with Mauritius, because when I talk about the second wave of industrialization in Africa, which Morocco is leading, people say, when was the first wave? The first wave was in the 1970s and the 80s. This is when South Africa, Mauritius, and Zimbabwe had the education levels they needed to be able to industrialize. They were just building the savings to support that as well. But it wasn't an easy job. And I would love to hear a little bit from you, Sunil, because you actually have the experience to know what was going on back in the 1980s. Because as I read, Mauritius was in a debt crisis. Mauritius was having to rely on the IMF to bail it out, I think, in the 1980s. I remember reading that one of the opposition politicians at the time said that Mauritius was like a colony of the IMF. And it was a really tough time. And yet that was the period when Mauritius moved from agricultural dependency, a country that Nobel Prize winners had written off as doomed, to a textile powerhouse in the 1980s, and then a finance success story today. So, Neil, could you talk us through some of that? And what role do you think equities maybe have played in helping Mauritius make this progress?
Thank you very much, Charlie. And first, I want to thank the Casablanca Stock Exchange for giving me this opportunity to participate in this panel. Yes, Charlie, you're very right. I think Mauritius, as you mentioned, is today one of the leading economies in Africa with one of the highest GDPs per capita. But just turn the clock back to 40 years ago, which is a relatively small period in history, and you would see a totally different landscape. So at the end of the 1970s and beginning of 1980s, Mauritius was nearly bankrupt. And the reason is very simple. We more or less faced the similar kind of trajectory that many African economies today are facing. We were essentially a commodity-based, sugar-centric monocrop economy, deriving most of its growth from the export of sugar to the rest of the world. And to give you a sense of perspective of how important and concentrated the Mauritian economy was only 40 years ago, sugar represented more than 30% of the country's GDP. It employed more than 50% of the labor force of the country. And more importantly, it represented nearly 70% of the foreign exchange earnings of the country. So when the price of sugar crashed at the end of the 1970s due to oversupply from Brazil and from Cuba, Mauritius, had its back against the wall. We became bankrupt. We had only 2 weeks of foreign exchange earnings for imports, which puts us, given that we were importing 95% of whatever we consume, so we were really, really in a big mess. And we had, as you rightly pointed out, needed to have recourse to a line of credit from the IMF. And all this came with a very painful structural adjustment program for the population, which included 2 successive devaluations of the currency, first by 30% in 1979, I think by some 20% 2 years later. But faced against the wall, and I think this is an important lesson when we try to think about how countries turn around the situation, we were lucky to have the right people in the right place in terms of policymakers who could size up the depth of the problem that we were facing, and who could identify the new strategic shift and new strategic orientation to move away from the mess in which we were. And more importantly, execution of that strategy was critical within a very short period of time. So what happened I won't take a long time, Mauritius went through a major diversification process of its economy, leveraging on the advantages that Mauritius represented in terms of its access to the European Union. So we went on a roadshow to the Far East, where, you know, garments, manufacturing was the center in those days. And we invited all these big business people who are involved in that sector, say, Mauritius is open for business. The government came with a series of tax incentives to attract these people. But more importantly, we told them, because of the privileged access that Mauritius gave to exporters because of our links to the European Union, so shifting your business to Mauritius and using Mauritius as a market to access the European Union made a lot of sense. You know, suddenly through Mauritius, they could access 300 million people potentially. So this was the first wave of diversification into the manufacturing sector. Then, of course, we went full blast on the tourism sector, given that we have pristine beaches and pristine waters and beautiful weather in Mauritius. So this also worked very well. And then the third leg, which is a very important leg, if you want to transform an economy, you need funding, as you rightly pointed out. You need funding in terms of debt, but you need funding in terms of equity, and so on and so forth. So the government understood that to accompany that transition phase, to accompany that transformational phase, it was important to have a working financial services sector. So they came up with a series of policies and changes to make our financial services sector more compelling, more robust, better regulated. And that's when a number of new institutions were set up, including the Stock Exchange of Mauritius. So the rest is history, because since the beginning of the 1980s, Mauritius has managed, between 1980 and 2000, one of the fastest growing cycle in its economic history, averaging more than 5% a year during that period. But right now, I think it's important to mention that Mauritius, as many other countries that have been successful, is now at crossroads in terms of what next. How do we keep on moving the economy from right now, I think our GDP per capita is about $12,000 after COVID, because it went down. We touched the high income economy status just before COVID, only to drop because of COVID. So the key question is, how do we make Mauritius a high income economy? How do we move up the value chain in terms of products and services that we offer? And this is currently the challenges that Mauritius as an economy needs to face. And I think there's a lot of thinking going on, both at the policymakers level, but also private sector level. And the agenda is, we need to open up more. We need to fight the problem of aging population and so on and so forth. But I will leave it here, because I think there's much more to discuss on this. Thank you.
There is, and I don't want, I find this history fascinating, because I think that transition, that 1980s transition of IMF dependency, so many countries in Africa today have IMF deals, and the shift to textiles and trying to get the textiles business from Asia. So what you went through in the 1980s is what much of Sub-Sahara is trying to get through now. So it's very relevant. How did the stock exchange fit into that? How did savings in general fit into that? You know, the situation of the pension funds, for example. Where did that come in?
No, very clearly, when you're trying to diversify into new sectors of activity, so you want a mix of foreign inflows of capital into the country. So that's where our road shows into the Far East and so on was very important. But you also rely on the local players, those that were involved in the sugar sector, and you try to get them to diversify and lead the change process into the new sectors like tourism and financial services. And that's where the stock exchange, has had and still has a very important role to allow these companies that were considering shifting their business into new lines of business to raise money and raise equity to accompany that change process. So that's how we fitted into this equation, and that's how I think it was very important to have a number of new institutions. One very key institution, I think, which is relevant to our discussion, which was set up by the policymakers in those days, was called, well, it's still called, the State Investment Corporation. So basically, what this was a government-funded investment company to take equity stake in new ventures that government wanted to push in terms of the new orientation of the economy. So they came with this idea. So they put some seed capital, or they took, let's say, a 20% stake into a new business, and then they invited private sector, but also foreigners sometimes to come in. But that was a very important arm in those days to help accompany that transition towards new sectors of activity and new areas of growth that the policymakers had identified.
Interesting. That's very interesting. Simon, can I move over to your side? I know you've thought about the financing side. I know you've done great work on pensions reform, pension systems, and so on. What could you add into this debate about getting the finance?
Well, you made the point at the beginning about the importance of savings, and I think a crucial point is how are those savings mobilized? So a contrast is between Egypt, where I spent a lot of time, and Morocco. In Egypt, you have a fairly high savings rate, but you have a lot of those savings are intermediated through state banks, which tend to finance the deficit or lend to, say, state institutions not in the most transparent way. Or you have savings going into real estate investment that is typically funded with cash or on an installment basis. And not a lot of the savings are sort of funneled through into the private sector. Now, in contrast, in Morocco, you have a well-developed pension system. So pension assets are around 30% of GDP. You also have quite a large mutual fund system. You have investment going into real estate, but a lot of that is funded by mortgages with the support of the government. And so pension funds can play a role in that. I'm not saying that the allocation of capital in Morocco is perfect, but I think when you have the intermediation of savings at some arm's length away from the state, you get better allocation of capital for the long run. And so looking at pensions in particular, it's striking. Morocco really stands out, not just in sub-Saharan Africa, but across the sort of frontier and smaller emerging markets we look at, with such a high level of pension savings in GDP. In Egypt, it's very low. It's sort of 2% of GDP. It barely exists. You have countries like Nigeria, which have quite rapidly in the past 10 years been able to build up quite a stock of pension savings. They're around 7% of GDP. Also in Kenya, but there's a lot more room to be done. And when you look more closely, you realize it's important not just to set up a pension system, but to get the incentives right. So in Nigeria, for example, you do have a shortage of the sort of infrastructure that you need. You do have the requirement for long-term capital. Unfortunately, you have a pension system that receives net contributions of around $100 million a month. I mean, it's a large system, but the incentives are wrong. The incentives are such that managers, they just want their NAV to go up, and so they put it all into fixed income. They're not worried about the real return. They're just focused on the nominal return. So you need to construct a pension system in which managers have the incentives to take the long view, to take that view that gives you a positive real return. And when you think about, you think about the demographics in Nigeria, the pension system in aggregate should be taking a 30-year view.
Yeah.
Should be putting more and more money into equities of one kind or another, whether it's Nigerian banks or with a bit of development into infrastructure projects. So you've got to design your systems right. And oddly, this is a problem, and I think you're running into in Morocco, where on the sort of liability side, parts of the Moroccan pension system, some promises have been made that cannot now be kept. So there are some funds in Morocco that are now sort of running into the sand because the liability is far greater than what can be funded. So you need to not just set up a good system, but to get your incentives right and continually be sort of managing the expectations, revising the system if necessary. One final point I'd like to make is, again, thinking about infrastructure and how you make that link between your pension systems, your financial markets, and that infrastructure investment. An example we've seen in Kuwait, of all places, which is obviously a very rich country, but one thing they have done is to link PPP projects with equity markets. So what they've done on some power projects, for example, is to earmark 1/3 of the equity in that project to a future listing, and so that gives an equitization at the end of a piece of infrastructure investment, and local savings institutions, local individuals will get skin in the game. So there is an exit already baked into the PPP contract. And that's worth emulating, I think, in Africa, where when you're setting up an infrastructure investment, you have an exit for some of the equity into local equity markets that local pension funds and local individuals can take part in.
That is interesting, because I've seen pension funds set up in Poland and Hungary in the 1990s, late 90s, which have copied the Mexican or Chilean system. They ended up with a lot of investment in equities. I didn't hear about any of them finding a way to help support infrastructure development. I'm aware that in Nigeria, when they did the electricity privatization, their goal in 2014-15 was for those companies to list then on the stock exchange at some point and give people a stake, exactly what you're talking about. But that's not happened, at least not yet. So there's definitely a barrier. But your point about the Nigerian pension system was really interesting. I mean, the last time I had a chat to them, I think they had something like 7% exposure to equities. And as I recall, in Hungary or Poland, it was more like 40% or 50% in equities. Is it partly a problem of not finding companies? So I'm going to go to Usim now to talk to him, because I'm just wondering, are there enough attractive companies? In Morocco, you're seeing these pension funds locally, it's kind of bidding up the equity price such that Moroccan companies are now saying, well, we have enough capital behind us, enough cash behind us to be able to expand abroad and to find the interesting opportunities. Usim, are you finding the interesting opportunities? And do you think the pension funds should be following you and buying the same stocks that you're buying?
Yeah, I mean, I'm based in Morocco, and I think that what Simon said is very realistic when we see what's happening in a major market in Africa like Morocco. We have around 75 companies. We have pension funds. We have major investors. We have insurance companies that are investing in listed equities. So all the environment is quite good to help and raise the Moroccan stock market, and particularly when we see the level of debt in this country that helped a lot the equity market, thanks to the fact that the yields in the bond markets were decreasing. So if we see the more generally in Africa, I mean, Africa is one continent, but it's a continent with very different markets. You have markets with more than 200 companies like Egypt or South Africa, but you also have markets with around 20, 30 companies like Ghana or Zambia, and between those markets, you have markets with 80, 100 companies like Tunisia, Morocco, or Kenya, for instance. So why those markets are attractive? I think that there are three main points that explain, I mean, why those markets they have to be seen by local investors and also by international investors. First one is growth. I mean, I'm not going to make an update on the growth situation of the African economies, but growth in Africa is helped by demography first, and second by the emergence of the middle class. So those 2 points are, I mean, very long term. I mean, points that each investor that invests in Africa has to keep in mind. The second point, and I've been working now for maybe 10 years in Africa, and I can say that the second point is the management teams. I mean, when you see the management teams in Africa, and I had the opportunity to work in Europe, I had the opportunity to work in Asia as well, and I can tell and I can say that the management teams in Africa are getting at the same level as this management teams of the major countries, and they obviously educated for growth. I mean, top line growth and bottom line growth, but they also educated to value creation. And as investors, for us, it's very important to talk and meet managers that are able to have a vision of what is return on capital employed and what is the ability for them to create value in the long term. But overall, and this is probably the main point. The main point that for me is saying that Africa stock markets are attractive is valuation. So valuation in Africa are very different. You have markets trading at 21, 22 times PE like Morocco, but you have also markets like Ghana trading at 6, 7 times PE. But if we see the markets in Africa, you can see that, I mean, you have a lot of markets trading at around 11, 12 times PE. And I would take the example of the BRVM market, Bourse Régionale des Valeurs Mobilières, which is a market that we do like a lot in Africa. And this is a market that is let's say a lead market with around 50 companies, and market with a lot of different companies and very interesting companies. So if we see this market, and if we compare it, for instance, to Morocco, pension funds, retail markets, insurance remain quite undeveloped. So it explains why, I mean, the liquidity of the companies or the valuations of the companies are not really, I mean, at the level that they should be. The second point is that the treasury yields are still high. Investors are more interested in investing in bond markets than in equity. But again, I mean, if we see the performance, the operational performance of those companies, particularly in the RVM, we see that, for instance, this year, a lot of companies they had a bottom line growing at 30-40% during H1, and if we see in the mid long term, you have like annualized, I mean, growth for those companies of around 20 or 25%. If I have to take examples, and I'm making quick because I see that time is going. But
I want the examples. I do want the examples.
If I have to take a few examples, I mean, in Africa Picking Fund, we like consumers. So in BRVM, we are invested in a company called Uniwax. It's an $80 million market cap company. The company is specialized in the production of wax-coated fabrics. And it's a very well-managed company. They invested during the last 3 years. And since 2021, they're seeing, I mean, the returns increasing thanks to this investment. We also, I mean, investing in companies in the insurance sector. Insurance sector is for us a very interesting sector. I see in the questions that are asked by people who are following the conference. I mean, what are the sectors that are interesting in Africa? I mean, for me, insurance is a very interesting sector because if we see the penetration rate of the insurance sector in Africa, it's very low. In some countries, it's less than 1%. For instance, in Nigeria, it's 0.4%. And if you compare it to the major market, you also see that there's a huge gap between those Africa companies in the insurance sector and the insurance companies in the major market. So if I have to give a few names of companies that we do know quite well in Africa, I would mention AXA Mansard in Nigeria, which is mainly held by AXA company. I would mention also Enterprise Group in Ghana. And Britam in Kenya. And if I have also to mention other sectors that we do like in Africa, I would mention education. So we have companies like Edivitech or Kuro in South Africa. But we also again have a lot of consumers. And one of the companies that we like the most in the consumer sector is the SAH Lilas, which is a company based in Tunisia. And it's a company that engages in the production of personal care and absorbent hygiene products such as disposable napkins or baby diapers.
Thank you very much indeed for that. So there are the opportunities there. The pension funds are not always grasping them across the continent, as Simon pointed out. Sunil, what can the stock exchanges do to try and improve the situation? What's your job now? And I don't mean just specifically for Morocco, and because you've addressed that middle income trap issue very well, but I'm just in general, what can the stock exchanges do to try and get more capital to support those companies that USIM is finding that are growing so well?
Well, thank you, Charlie. Before I answer this question, I just wanted to rebound on one of the issues raised by Simon with regard to pension funds. In fact, one thing that I have observed in many countries, especially countries like Mauritius, where the assets under management of pension funds probably is higher than 50% of the country's GDP. So you have a quite representative pension fund sector, private and public. But what I've noticed is they tend to be extremely conservative. Probably, as you mentioned, Simon, they want to ensure that their NAV doesn't go down and so on, and they are not willing probably to take risks. But I think the most important challenge that many national pension funds across Africa are today facing is they are being used as captive investors for government bonds issued by the local governments or the local authorities. So if you take, for example, in Mauritius, I would say the largest pension fund probably has more than 50% or 60% of its AUM invested in long-term, medium and long-term government bonds, and a little bit in equity local and a little bit in equity abroad. But if you look at the funding needs of these pension funds, especially in a context where you have an aging population, you would have expected, you know, an asset allocation that would have favored long-term growth rather than have short-term low interest. Probably, as Mr. Oussam was mentioning, the nominal rates of interest on many African government bonds are today double digits because of high inflation. So probably this is distracting, you know, investments from the equity market into these government bonds. But in Mauritius, rates are very low. It's 1%. So, you know, this is a time for pension funds to look at more investments into equity and so on. Now, coming back to your question about what I think you rightly pointed that the big challenge that African countries will face is the funding gap. We all know that there is an annual need of $150 to $170 billion of funding for infrastructure only, and probably twice that amount for funding of private sector entities across Africa. So it's very clear that this funding gap, which is about 50% of that amount that I've mentioned, is not going to come from, you know, DFIs, it's not going to come from foreign aid or whatever. So given that the whole world is flush with capital looking for attractive investment opportunities, I think now is the time for African countries at the macro level, but also African players at the micro level, and for stock exchanges to try to bring in a number of reforms so as to make them more attractive and more compelling from those people that we are targeting to bring capital to us. So what are some of these reforms? I think at the micro level, I always like to say that there is a need for us as exchanges, but also for players within the exchange ecosystem to stimulate the 4 Ps, okay? 4 Ps, what are these Ps? Products. I think if you do a scrutinization of, you know, what kind of products are today listed or traded on the majority of African exchanges, they're all very much equity-centric, except for a couple like Kenya and others, where you have a variety of products. Mauritius also has diversified quite a lot in terms of new products. So if you want to attract players, you need to have products. So this brings us to the famous question you asked, Charlie, about the chicken and egg. Why are pension funds not investing? Is it because there is a lack of investable products? I think Mr. Oussam clearly mentioned, no, there are products, but probably not enough. So the key question is, how do we increase the number of investable products that would be attractive to the investor base, be it local or international, that we are trying to attract? I think there are a number of big companies in Africa that when they reach a size, they go and list in London. Fine. probably because they raise the capital, but they also have, I think, a role, as being part of the African ecosystem. They have a role of development towards their own local economies and their own local stock exchanges. So we need those champions in Africa to come and list in their home markets so as to grow the size of these markets, to improve the liquidity and diversify the product base. I would also believe that is very important. If you look, and I'm sure if you ask around this question to the policymakers in different African countries, not many of them have had a good understanding of the main problem that you've highlighted, Charlie. It's about funding, okay? Not many of them understand that stock exchanges and capital markets have a critical role in getting them to speed with this funding gap. So there is a need to sensitize these people so that in terms of policy making, they put a lot of focus in terms of how do we grow these markets? How do we make them more dynamic? How do we make them more appealing? So that includes also pension fund reforms and so on. Players, we need more players, so we need to attract those international players. You were talking about annualized 20% growth rate. That's fantastic. If you discount that with the inflation rate, probably you have a real rate of return in many African markets today, which is around 6-7% in real terms, which is not bad compared to negative interest rates that people are getting in the developed world. So we need to sell our story. We need to attract more foreign players, but to do that, we need to make sure that in terms of governance at the political level, but also in terms of governance at the company-specific level, we have the right mix of governance so that these people have the confidence. I think we would also need to see how we bring in more partnerships, linkages among African exchanges so that through technology and other mechanisms, I know that the AFDB right now is piloting a project which is called the African Exchange Linkage Project, which is trying to link through technology 7 exchanges across the continent so as to allow brokers in Egypt, for example, who is part of that, to invest in Mauritius and vice versa, so that we have more order flows coming into our market, I think improving liquidity. And one thing that we would need to address, but this is also a chicken and egg situation. I think the cost of trading is very high in Africa compared to the rest of the world. But it's understandable because you have so little products listed and traded that to make the exchanges viable, they need to derive some form of income. But if tomorrow we manage to diversify the product base, we manage to increase the participants, the players, and improve liquidity, this would create a sort of appropriate environment to start reducing the cost and eventually spur more liquidity on these markets.
Thank you. I'm conscious that we've got 10, 15 minutes left. We've got these questions coming in on the right-hand side, which I think everyone can see. So if any of you can tie in some of your answers to what I'm about to ask as well, to any of those questions, that would be great. But Simon, I just wanted to come to you in light of what Sunil had said. So he's talking about what he thinks the exchanges can do, what they can try and push for. You're talking to foreign investors, as I am. What's your impression about what they are looking for? What can be done to make it cooler? I'm over to you.
It depends, is the short answer. I'll expand on that. In some countries, so I'll take a couple of examples. In Nigeria, it's the big picture, right? So you have an immensely exciting opportunity in Nigeria, a large population, a sort of quite dynamic entrepreneurial economy, but the management at the top is not ideal. So you have an FX policy that is difficult to understand, quite an old-fashioned approach to managing the economy, and that's that just sort of puts it out of bounds for a lot of people. And if you can't get your money in and out, people are just not interested. There is foreign money going into Nigeria regularly, and it's going into private equity, and I expect that to continue. There are listed companies that people find interesting, the consumer stocks, the telco, even the banks, but people are just not willing to come in right now because of the FX regime and the way the economy is run. In Egypt, it's sort of more micro level. So it's just people have been frustrated by cancelled trades, the way that the sort of closing auction is managed, and these sort of things. Because I should make a sort of a broader point. Passively managed money is very, very important for global equity markets at the moment, and it will remain so. We don't see a lot of it in African markets because they're not really liquid enough, but they are a constituency that exchanges and regulators must pay attention to. If your Vanguard or your iShares need something, a certain setup in the market, you really should pay attention. Because they may not be your customer right now, but you want them to be. And so when they have certain sort of requirements on how markets are funded or trades are funded, on settlement and so on, you have to pay attention. So that's an issue that I've seen in Egypt in the last couple of years. And then you just need more issues. You need, it comes back to Sunil's point. You need to see some more companies. Can governments come up with some incentives to get companies to list at home rather than in the UK or elsewhere? A small tax incentive to bring those companies to market that can really help. We do see what you can call crossover interest, so global emerging market funds coming into African markets, but it's very selective. So we've seen it in the last year in Safaricom because it's not just another bank. It ticks a lot of boxes. It's sort of sexy in terms of global market trends. It's got a fintech aspect. It taps in directly into an emerging middle class, and for that reason, you've seen a lot of global emerging market funds come into that stock. There are very few other African stocks that have seen that sort of interest, apart from in South Africa, of course. That there is interest in the Africa story. There was the headline today: Vivo Energy is being taken out by Vitol because they see the opportunity in Africa. So the demographic story is there. The real growth potential that Sunil mentioned is there. I think that the barriers are institutional barriers that can really be overcome by listening to what investors want. And it can be something as mundane as how is your closing price calculated, or something as large as how you manage your exchange rate.
That was very helpful because I think it is giving that specific advice. I noticed one of the questions we've got here is related to what would be the average return that should be reached by African markets to interest international investors. So seeing when you're trying to raise money, what are people looking for when they put money into an Africa fund versus whatever fund they might do in the US or something? What sort of return are they expecting from you?
Well, if we talk about the international investors, I think that the point for them is obviously first point is for them diversification. So they're not, most of them, they do not know. I mean, what are the companies in Africa? They never invested in listed equities in Africa, and for them it's quite, difficult markets because there are political issues, currency issues. And I remember when I created Of Africa, now around 10 years ago, most of the investors that I used to talk to in Europe, they were saying, yes, Africa, it's too difficult for us. We are happy with our investments in Europe, in the US, in Asia. And in reality, if you see, what happened in the last 7 or 8 years, you see that those major markets, they overperform quite significantly. I mean, those emerging and frontier markets, and particularly the frontier markets in Africa in particular. So they just like mentioning the fact that, and if I have to rebound on what Simon said, I mean, currency is today the main issue for them, because when an investor they put money like if an investor put money like in Egypt in 2016, they got like the two hits, like in March or April with devaluation, and in November with the flotation. So in just 1 year, the international investor he lost like 50 or 60% just only because of the currency. And regarding that, I think there are today 3 different categories. So the first category is those countries like Egypt that decided to go to flotation, which is very good in the long term. They suffered a lot during a few months after this flotation with the huge increase of inflation. You have the second countries like Nigeria, which is still struggling with that. We have like an official exchange rate and a parallel exchange rate with sometimes spread going to 50%. And between them, you have like countries, for instance, like Morocco, that are doing a great job, that are just like understanding that they have to go to flotation, but they're doing it gradually. So those countries understood that at the end of the day, they have to have a currency which is a currency that can be exchanged all around the world, and that's a very important point for investors to invest in a country and to be sure that they're taking a risk by investing in companies, but not by investing in currencies.
Okay, so there's not a specific number. It's a diversification play for them rather than we need 10% return or 25% return before we'll give you money. That's not what you're getting told. You're not being given a number target.
No, I mean, it's difficult to give a target of the returns that you can get, I mean, in Africa. Obviously, you have to consider the level of debt. In the African countries, you have to consider the level of inflation.
Sure,
as well.
But you're not looking. I've got clients who raise money and they say, "Look, we've made 17% return every year for the last 5 years. That's why you give me money." But that's not why people are coming to you.
No, they're coming to me because they, particularly in Europe. I mean, most of them they never invested in Africa, and they want to diversify their investments. And when they see the growth stories and when they see the valuations of the African companies, they just realize that there are other markets than the markets that they were invested in.
Gotcha. Thank you very much. I've noticed we've got about 3 minutes now. We've got a whole host of questions that have come in. I want 30-second answers to any of these that you are looking at. If you put your hand up and say, "I've read that question, I'd like to answer that." Oh, good. Simon first, because he was quickest.
There was one about what can be done to get pension funds to put more into stocks. Minimums, right? You've got to put a certain amount in equities. It's something Sunil made the point about pension funds being, captive pools of liquidity for governments. But if you take a long view and you say, if you are a pension fund, you need to put, let's say, 10 or 15% of your assets into stocks, and you build it up over time. Nigeria took a backward step 2 or 3 years ago as their deficit blew out, no coincidence, and said, we're going to strip those minimums, even for the riskier funds. Gotcha. So now they don't have to put anything into stocks.
That was nearly 30 seconds. Thank you, Simon. Sunil, it's not the same question, I hope.
No, it's about, African indices have increased and, how post-pandemic post-pandemic in the current environment, and how did the international investors react to that? Well, what I've seen is African foreign investors their reaction has been fairly muted, in spite of the fact that many of the African markets have recovered over the last few months from their historical lows that they hit last year in the advent of the COVID-19. I think it's because if you look at the currency performances of many African countries, their currencies have not behaved very well against the US dollar. So investors, when they look at the potential return, they would look at, what about the potential return in US dollar terms? So the indices may be increasing in local currency terms, and until arrives a time where, these increases are compelling from a US dollar perspective, I think we will continue to see in some markets the fairly muted reactions. And just to end, Charlie, when you started, you mentioned that your concern about many African countries today is about they are over levered. Okay, they have external debt that is very important. And I just read a statement from Mark Mobius before I joined the panel, where he was raising the alarm bell concerning currency crisis in emerging markets. He was not very specific about Africa, but I think we are on the same boat in some countries where an increase in interest rates in the US will create, default issues in with those countries that have huge amounts of exposure to external debt. So we need to tackle this. I'm not saying that this is the case in all across Africa, but in selected African countries, I think this is becoming an important issue. But this being said, I think by and large, African markets and African exchanges present tremendous opportunities simply because the growth rates over the last 10 years have been very, very high in many African countries. And we've only scratched the surface in terms of the potential. What we need is get the policies right, have the right policy mix in terms of reducing exposure to debt, ensuring that our currencies are behaving properly against the US dollar and other currencies, and then tackle all those micro structure problems that we have all mentioned: pension funds, lack of products, and so on and so forth. But I think
I just need to think we need to finish up now, but I'm going to just run through the questions and explain that we have, I think, answered most of them. Do you think it's useful for exchanges in Africa to integrate? And I think Sunil has said, yes, 7 are in discussions about more integration. What are the hottest sectors? And Usim has answered that. And, well, he loves insurance and he's loving the consumer. So there are good sectors here. The average return question was a little bit of a tough one. We're suggesting it's a diversification play as well. African investors, Sunil's just answered that. Post-pandemic, there is interest. The commodity story has helped that interest in some countries. Domestic pension funds. Simon was really powerful on this, very helpful, and suggesting we should have limits, bottom limits, to make sure people do invest. And then lastly, is there a role for more infrastructure funds? Well, hopefully so. So I'd like to thank the panel. You've been great, guys. I really appreciate your help and support. Let's do this again sometime. And thank you to Asia for putting us together. Thank you very much.
Thank you, Charlie.
Yeah. Thank you, Charles, and thank you to all the panelists for your interesting contribution to today's first panel. So in a few minutes, we'll be moving to a presentation by Mrs. Lina Tonwi, Project Manager for the African Exchanges Linkage Project. Mrs. Tonwi will explore the topic of African capital market integration. Enjoy the presentation.
Okay, a very good afternoon or good morning to everybody who is joining from wherever you are. It is a great pleasure to be joining this great discussion, and congratulations to Casablanca Stock Exchange for this great webinar, and to Azer. So I'll just jump in. As you have heard, my name is Lina Tonui, and I am the project manager for the African Exchanges Linkage Project. And there has been a great discussion just before I joined in, and you know, keeping with the theme about African integration, and adding on to what Sunil has you know, confirmed, that yes, the African capital markets do need to integrate and participate in, you know, the momentum that there is now for interest in African capital markets. So just to jump in, I will go ahead and share my screen, as you can all see it on there. I believe I will do just a full screen, and just give a brief introduction about the African Exchanges Linkage Project. And in my outline, I will, you know, talk about the expected outcomes and value add from the integration of African securities exchanges, market readiness assessments that have been done, the achievements that we have, you know, made so far, and then the next steps. So first of all, the African Exchanges Linkage Project is a co-initiative of the African Securities Exchanges Association, AZER, and the African Development Bank to facilitate cross-border investment flows through trading of securities across participating exchanges in Africa. And the main objectives are to boost Pan-African investment flows, to enable seamless trading of securities in the participating exchanges, to facilitate access to and free flow of information on these African capital markets, and also to the investment community as a whole. And so we also aim to promote innovations. This is definitely part of the AZER agenda, and you know, and mission is to, you know, promote innovation in product creation that would support the diversification needs of investors within Africa and without Africa. And then also to build capacity for regulatory and policy formulation and standards harmonization. And so one of the other major objectives is to address the lack of depth and liquidity in African capital markets. I believe that, you know, other speakers before me have talked about the exchanges that are participating in this project. So in phase one, we will create linkages among 7 African exchanges representing, you know, over 90% of Africa's market capitalization. And these exchanges that are participating in the AELP are the Nairobi Securities Exchange, the Johannesburg Stock Exchange, Casablanca Stock Exchange, the Nigerian Exchange, the Stock Exchange of Mauritius, the Egyptian Exchange, and BRVM. So the expected outcomes, you know, it's really to link exchanges, you know, with market capitalization of over USD 1 trillion. So this will, you know, create visibility to both domestic and global institutional investors, as I had mentioned earlier, and to also provide, you know, diversification for these investors. And so investment products that will be available on these 7 exchanges include equities, bonds, derivatives, ETF, REITs, and others. And, you know, as innovation continues in these exchanges, then, you know, more products and services will be included, first of all, in these exchanges. And then as we grow, then more products, I mean, as we grow, more exchanges will join the project, and even more products will be available. And also the AELP also seeks to be a one-stop shop to most of the significant African market saving transactions and operational costs. And then business expansion for investor community through access to a larger market and improved liquidity. And then we have innovations in services and investment products, thereby increasing and diversifying opportunities for Africa's investment community. So value add, this is just a summary of what I have just said. We'll be connecting 7 exchanges, 14 countries, and approximately 1.4 trillion equity market capitalization. That number is as of December 2020, and there's more, growth that has been seen in these exchanges. So we'll provide again back to the list of products and access to Africa's largest companies. There are definitely more companies that have joined this list, but there'll be a lot more that different investors can, and a lot more companies that investors can, invest in. So in the beginning, in preparation for this project, there have been, market readiness surveys and assessments. The criteria for selecting participating exchanges for AELP Phase 1 were selected through a discussion and collaboration with the Africa Development Bank and all the exchanges that are participating at the moment. And this was mainly facilitated by ASEA. So criteria number 1 is the regulatory considerations for each of the markets. There was a study on the custody and settlement processes in these countries. And then foreign exchange management and FX settlement. This is definitely a big area for discussion in cross-border trading. And then the market environment of each of these exchanges, and then taxation on investments and securities lending. And then criteria number 6 was the order routing system for third-party trading. This report mostly was shared internally among the exchanges, and any new exchanges that will join the AELP will also, go through the same assessment, either for Phase 1 or Phase 2, as we seek to expand the project. And so in order to facilitate cross-border trading and the implementation of the AELP, the African Development Bank mobilized a grant of USD 980,000 from the Korea Africa Economic Cooperation Trust Fund. And this fund or grant was broken into 3 major components. So first of all, there's the AELP technology platform. So the procurement of that has been ongoing, and we have finalized that. So the AELP Link technology platform is a universal trading terminal, which will offer real-time data aggregation and will accommodate multiple asset classes, same as what is available in those exchanges. And so there has been great progress in that. And the second part is capacity building. We really, it is very important that stakeholder engagement, capacity building within these markets and outside of these markets. And so there has been a lot of awareness raising in these markets, and generally through seminars and webinars like these, we have raised more awareness about the project, and there has been a lot of interest in participating in the project and more visibility. And then the third component is a project management office, which was finalized. So procurement of the project manager and the assistant was finalized in 2019. And now I am in the project management office. And then the next step will be the procurement of an audit firm at the end of the project. So, you know, all the achievements and the progress that we have made so far is definitely in interconnectivity of securities exchanges. Like I had mentioned, the procurement of the AELP Link technology platform. We have procured an experienced technology firm, Direct FN, who is one of the sponsors of this event, and I don't think I can, you know, advertise them more than you all have heard, and it's a great partnership with them. So they have been onboarded. We're currently in the process of, you know, getting integration happening for the 7 exchanges. So they will provide an order routing system for the 7 participating exchanges, and a market and order book data sharing among the stock exchanges and brokers that will participate in this. So the technical and functional specifications for this, for the ALP link, was mostly supported by the IT experts from the 7 exchanges. You know, they understand the need more than anybody else, and so they created a link that will work for them and for the exchanges, just to make, to make it relevant for this project. And capacity building for financial industry regulators and operators, training programs targeting financial industry ecosystem has been successfully organized under this project. A lot of them, you know, started in 2019 at the beginning of the project, and there's more, you know, capacity building that continues. The next part will really be to engage the stockbrokers and securities dealers, and we have worked out a plan with Direct FN that will build capacity among the stakeholders. And we have created a website for the ELP, which was launched in March of this year. You're welcome to visit the africanexchangeslink.com for more information. And again, as I said, you know, stockbrokers and security dealers will be a key part, will play a key part in the success of the project. And so there has been an establishment of the African Stockbrokers and Securities Dealers Association, ASDA. So AFDB supported this, and they are members, or rather the participants in this in ASDA currently are the 7 exchanges, but then they are expanding to include stockbrokers and dealers in all the ASEA member exchanges. So this is the first Pan-African platform for security dealers to collaborate on capital market integration and product innovation. And then we have the establishment again of the project management office that I have already talked about. And so ASEA has, you know, in addition to collaboration with the Africa Development Bank, they're also, you know, working alongside getting the African Union Commission involved in this. And so the AELP will also seek in, will participate, you know, in the AFCFTA objectives of creating jobs and enabling movement of capital and people, facilitating investments, and to deepen the economic integration in general of the African continent. So the next steps for AELP, we will continue with communication and information dissemination. So sensitization workshops, as I had mentioned earlier, has been done through ASDA, and this is an ongoing process. So ASDA is a very active member of the implementation committee, who will liaise mostly with the exchanges to bring on board the brokers to participate, to increase awareness on the project, and also just to partner with us, especially with, you know, the general integration of African capital markets. So we'll have continuous webinars. For just different investor groups and, regulators and different market operators. So we have also done a few surveys. We have done an investor appetite survey of asset managers and pension funds. This was finalized in 2020, and the report is available on our website, and you can go in there. And that report indicates that there's definitely a lot of interest from the buy side in the ALP. So we expect that the launch will happen in 2022. The implementation of the technology platform is currently underway. And, for the market integration is definitely more than just the infrastructure. The infrastructure plays a major role, but there's a lot of work that has to go in through, like I said, working with the regulators. There is regulatory reforms that are required. And the phase 2 of the project will, work more towards harmonization of these regulations and seeking ways to understand how, this will become a reality, and also just to remove all the blockages, or work at least towards removing the blockages, working in cooperation with, the African Union and the AFDB and larger bodies that will help us lobby for change that will lead to a successful implementation and integration of these markets. So due to substantial interest from other African countries to participate in the ALP, phase 2 will also see more brokers and more African stock exchanges participate in this. Once proof of concept has been finalized in phase 1, we will onboard more exchanges. And because this project is really about integrating the whole of Africa, and so it has to be an inclusive project. And the more exchanges we have, the more diversity, the more opportunities for investment and innovation. So applications are ongoing from different exchanges, and like as I had mentioned earlier, the criteria has been set, and so the aim is really to get each exchange to participate. As you're aware, there are already some regional integration projects and processes that are going on in different regions of Africa. And so the AELP seeks to bring together all these different smaller integrations into, the umbrella of AELP. So that is a snapshot of what the African Exchanges Linkage Project aims to do. We look forward to a successful implementation. And again, as I had mentioned earlier, that broker participation is key. And so we call on brokers, we call on investors to come in and participate. And I will end my presentation there, and definitely, open the floor for discussion and questions.
Thank you. Thank you very much, Lina, for your insights on the African capital markets integration. So our next presentation will tackle the subject of blended finance in African capital markets, and will be presented by Mrs. Lade Araba, Manager Director for Africa from Convergence Finance. So the floor is yours, Mrs. Araba. Mrs. Lade Araba, thank you for joining us. You can start now.
Thank you so much. Good morning and good afternoon to everybody who's connected, wherever you're joining us from. I'm absolutely delighted to be here. And I'd like to thank the organizers of the ASEA conference for this kind invitation. I want to start by quickly introducing Convergence. We are the global network for blended finance, and we generate proprietary data, market intelligence, as well as deal flow with the intention to catalyze private investment at scale towards SDG-related transactions in developing countries. And we also provide early stage grants for innovative blended finance vehicles that have the potential both for scale as well as replication. What is blended finance? For us, it's simply a financial structuring approach that leverages concessional capital from either public or philanthropic sources to de-risk transactions and thereby improve their risk-return profile so that they appeal to private investors. And typically, we would expect that a blended transaction is able to deliver an attractive risk-adjusted return. It is contributing to at least one of the Sustainable Development Goals, and there's also leverage. So each dollar of concessional capital, as an example, is able to pull in $3 or $4 from the private sector. When you think about the investment decisions that investors traditionally make, they're typically looking at how to mitigate the transactional risks and also enhance the potential or expected returns for the investment. And when we consider investments in emerging markets, oftentimes the transactional risks tend to be more significant than the expected return in real terms. So what blended finance does is to create a rebalancing of the risk-return profiles by, again, managing or structuring those risks and also potentially improving the expected upside for the investor. What this looks like in practice, if we were to create a portfolio of risk-free securities and we were to plot this on a graph with the x-axis representing the expected risk and the y-axis the expected return, we could create this blue market line that I have depicted on the right of the screen. So for any investor considering an opportunity in an emerging market, whether it's a listed opportunity or not, they would be comparing this to this portfolio that we have created here and have plotted on the graph. And so they would only make an investment if the transaction sits on the blue market line or sits above it. So if we were to have a listed security that falls at point A, which means that it is considered highly risky, but then the expected return is not commensurate with the profile that the investor expects, then they would not place capital into that transaction. So what blended finance would do is to de-risk by reallocating some of the transactional risks. So shifting the transaction from point A back to point B so it sits again on that blue market line, and effectively the concessional capital provider, whether public or philanthropic, is then willing to absorb those transactional risks to ensure that the ultimate impact of the deal is achieved and the investor does not have to compromise their commercial mandate. A second alternative is where instead of de-risking, blended finance is used to enhance the expected return or create an even more attractive potential upside for the investor, thereby shifting the transaction from point A to point C so it sits back on that blue market line. So you're basically leveraging blended finance either for downside protection or to enhance the potential upside. Now, what this looks like, again, in practice, if we had a listed security that would normally be rated B+, and we were to look at the expected annual losses, it would put us at 1.21%. Through blended finance, we can apply credit enhancement in the form of guarantees or other instruments and effectively get that security to be investment grade at BBB, and thereby the arithmetic calculation is simply that you would need to ensure that the credit enhancement that probably introduces a junior layer of capital is sufficient to absorb the expected losses at the risk rating. So we would then subtract 0.16 at a triple B rating from the expected losses at B+, which is 1.21%. And that is how we would know how to size the risk layer. What blended finance structures typically look like would include concessional capital within the capital stack, as I've just mentioned. So you would often see subordinated debt, you would see junior equity with first loss protection, you would see guarantees, which I've just described and given an example of, and also risk insurance products. We've also seen technical assistance being applied in these types of transactions, and I will mention this in an example that I will discuss in a few slides. And then finally, it's also early stage grants, which can be used for a variety of purposes. So examples of blended listed securities. Acorn issued the first green bond in Kenya back in 2019. It's dual listed on the Nairobi Stock Exchange as well as the London Stock Exchange. And effectively, the proceeds will be used for providing affordable housing for students in Nairobi, Kenya. And these will be green certified buildings. So the bond issuance benefited from a partially returnable grant provided by the Technical Assistance Facility that was used to offset some of the costs of the issuance, but also the green certification. And it also benefited from a 50% partial credit guarantee provided by Garantco, which basically covered principal and interest for investors. As a result of this credit enhancement provided by Garantco, the issuance, the bond was rated B1 by Moody's. And it's important to note that the sovereign rating for Kenya is actually B2. So this bond was rated one notch above the sovereign. So it shows you that blended finance can be utilized, again, in this manner to improve the overall profile of transactions, but also the credit rating. Another example is a corporate bond that is also dual listed both on the Ghana Stock Exchange as well as, again, on the LSE. And it did have a 75% partial credit guarantee provided by Garantco, and it was issued by Quantum Group, which is a corporate in Ghana that works in the oil and gas field. And this would be utilized, the proceeds would be utilized to expand their LPG operations. This is also the first time that a bond from Ghana listed on the London Stock Exchange, and basically it was paying the bondholders 22.5%, an annual fixed interest rate of 22.5%. When we think about the overall blended finance market, we have seen a consistent uptick in the volume of activity, especially from around 2015 with the adoption of the Sustainable Development Goals. And overall, we've seen about $160 billion flow into blended transactions in emerging markets with just under 1,500 unique investors making over 5,000 unique commitments. Most of this activity has targeted Sub-Saharan Africa, which represents almost half of the global blended finance market. And a lot of the transactions have happened in lower middle income as well as low income countries. When we look at the sectors that have had the most level of activity, we see that energy and financial services have historically been those sectors with the most number of deals done. And energy would include utility scale renewable energy projects, as well as off-grid solutions, which include mini grids, microgrids, solar home systems, and so on. Financial services includes a variety of subsectors such as microfinance, fintech, and other access to finance type opportunities. We're seeing an increase in agriculture as well, with some very interesting products being developed, and then to a lesser degree, other infrastructure subsectors. In the last year and a half, we've also seen a significant increase in healthcare, with some interesting products being developed. So healthcare before the pandemic accounted for about 3% of the global market, and we see that today it's already at 5%, and we expect this upward trend to continue. We also look at who the most active investors and funders are within these types of transactions. And when we look within the various segments, we find that the US government through USAID, as well as the German government through BMZ, are the most active donor agencies by the number of deals that they have participated in. We've also seen a lot of activity from the multilateral development banks, as well as the development finance institutions, with the IFC and the Dutch FMO being involved in the most number of deals. On the philanthropic end, we've seen quite a bit of activity from the Shell Foundation, as well as the Rockefeller Foundation, and privates, which effectively includes institutional investors. We've lumped in banks, private equity firms, but we've seen a lot of activity from a number of banks as well, especially investing in infrastructure assets and those types of securities. When we think specifically about listed transactions, we find that there have been 49 listed bonds that are blended in aggregate, raising about $6 billion worth of financing with over 70 unique investors. And most of these transactions, consistent with what we've seen in the overall blended finance market, have targeted energy and financial services. And then we also see that other infrastructure subsectors have also seen quite a bit of activity. And then to a lesser degree, agriculture, health, and education. We also note that Africa accounts for just under a quarter of these listed transactions, and Asia is more prominent, and then we can see to a lesser degree other regions. How blended finance is applied in these listed securities. So most of them, so about 61%, actually have some form of guarantee. So we see that credit enhancement is quite significant. And then to a lesser degree, we've seen the first loss or concessional capital in the capital stack, as I showed in an earlier example, as well as the grants that are utilized to offset some of the costs related to the issuances. In terms of who has invested in these securities, so we've seen that, again, the multilateral development banks and the DFIs have been quite important, but then we've also seen traditional institutional capital coming into these transactions. And then to a lesser degree, we've seen impact investors and also some foundations and philanthropic organizations. Who are the target direct beneficiaries as well as the ultimate beneficiaries? So the proceeds for these listed securities have often been used to benefit businesses, so mid-sized businesses. We've also seen microfinance institutions be direct beneficiaries, other financial institutions, as well as SMEs and women and children. And then the ultimate beneficiaries, we see that a third of these transactions are actually directly benefiting the bottom of the pyramid, so the poorest of the poor, which is a good indication of the ability of blended finance to achieve multiple objectives, which includes creating that impact while at the same time enabling investors to achieve the yields that they are seeking. And then we also see that micro, small, medium enterprises, as well as women and girls and entrepreneurs, have also benefited from these transactions. The most active investors in these listed securities, again, on the donor side, we've seen a lot of activity from the US government, but also the PIDGE group, which is the Private Infrastructure Development Group, a donor-funded facility that includes a number of donors in Europe. We've also seen Garantco be quite prominent. As I mentioned in my two examples, they have provided credit enhancement for those two listed bonds that I mentioned. On the philanthropic end, we've seen quite a bit of activity from the Rockefeller Foundation. We've also seen some banks be involved, Société Générale, as well as Credit Suisse. And then we've also noted activity from impact investors who have a dual mandate, and these include primarily Frontclear and Blue Orchard, who participated in a couple of these issuances. When we look specifically within the African context, we have seen 15 blended bonds be listed on African stock exchanges, representing just under $3 billion worth worth of capital. We've seen 45 financial commitments, and you also see that the majority of these issuances have fallen in the $10 to $25 million range, although we have some slightly bigger issuances noted as well. Most of these have been in infrastructure, so just about 30% have actually targeted infrastructure. And then we've seen another 21% specifically looking at energy as well as financial services. And then some of the other subsectors, housing has also been quite prominent, also at 21%. Where in Africa have these bonds been listed? So we see that half of them have been in West Africa, 43% in East Africa, and 7% in Southern Africa. So we see there's been quite a bit of activity in multiple regions. Who have been the investors in these African listed bonds? So we've seen a very important role being played by development agencies, just under 50%. Have had capital from these donors. We've also seen the multilateral development banks also be quite prominent. And then to a lesser degree, other types of financial institutions, investment managers, asset managers, and so on. So on that note, I would like to pause, and I'm happy to take any questions if there are any.
Thank you very much, Mrs. Lade, for your vibrant presentation on blended finance in African capital markets. I guess there are no questions. So we look forward to seeing you all in the afternoon for more interesting panels and presentations by our experts. Our afternoon session will start at 2 p.m. with a panel on the financing of small and medium enterprises. See you, everyone.